Many people experience retirement as an amazing transition. In fact, it's one of the biggest transitions we go through in life. But that transition is not satisfying for everyone. And the reason for that is there are some risks that your retirement income plan needs to deal with. And if you deal with them successfully, you'll have a great retirement. If you don't deal with them successfully, it'll create anxiety, concern, and lead to a less than satisfying retirement journey. So in this video, we are going to talk about those risks. Now as well, what's exciting about this video is the start of a journey. We've created a series that we call How to Retire. So on a regular basis, we'll be posting a series of videos dealing with the key aspects of retirement planning. Now, not all the videos will apply to you. It's going to be a comprehensive series of videos. However, as we build the playlist, make sure that you visit it on a regular basis. So make sure you subscribe, make sure that you have the alert bells on so you don't miss future content on our How to Retire series. Now, in the show notes for each video, we'll have links to helpful free resources, PDF documents, and other planning tools that will help you in your own personal planning for retirement. And we'll link in the show notes other videos we've done that would be helpful supplemental material to the video that you're watching. So again, thanks for taking the time to watch this video. Let's get into the discussion on key risks to deal with in your retirement planning journey. Now, I created a bit of a roadmap for our journey through the various videos. Of course, today we're going to talk about retirement risks. But over the next several weeks to a few months, we'll be posting content on each of these topic areas in what we think is a great sequential order for retirement income planning. So you can go on this journey with us to prepare your plan. The next video will talk about goals, so goal setting process for retirement, cash flow and budgeting, retirement accounts, RSPs, RIFs, LIRAs, LIFs, PRIFs, defined contribution plans, defined benefit plans, soup to nuts, all those different topics, how you coordinate all those buckets for your retirement plan. We'll look at government benefits, CPP, OAS, GIS, and how you can maximize your government benefits, tax planning in retirement, really critical, getting into tax-effective deaccumulation plans, generating income, some mechanics around that, and then retirement investing. So if you're managing your own retirement portfolio, what strategies to use, connecting the dots between your goals, your cash flow needs, and how you construct your portfolio. We'll get into legacy and estate planning, psychology of retirement, healthcare, and of course, lifestyle issues through the retirement journey. So this will be a really practical, hands-on exercise. Make sure you subscribe so you don't miss future alerts on the content that we'll be posting, and then you can go to the playlist as we begin to build it together. So when you talk about retirement risks, there's really two critical categories. So one category is the financial risks, and I put them basically under the topic of longevity risk, market risk, accumulation risk, and inflation risk. Now, there are non-financial risks as well, and that gets into how retirement impacts relationships, our sense of purpose, meaning, how we use our time, and of course, for the various aspects of health risks in retirement. Now, today we'll talk about the financial risks. Now, when we talk about retirement risks, we talk about them and deal with them specifically in the context of a process that we put together. And our process is influenced by this idea that retirement planning is really like flying to a destination, and it has three phases. Phase one would be the runway phase, where you're getting ready to take off. You have the takeoff phase, and then you have the flight and journey phase. And in each phase, there are a series of checklists and strategies that you need to implement. So as we go through today, we'll just identify the risk. Purpose of the video series is to tackle each of those risks head on with practical strategies. But runway, takeoff, and then flight and journey is the basic approach. Now let's look at a few other items that we need to consider before talking about the risks. So there are 4 micro strategies that need to be monitored and acted on a regular basis as part of the risk management process in a retirement plan. So the first area is make sure that you understand that little differences have a big impact over the length of your retirement. So if you're just off 1% in your planning, you could be way off course. Again, going back to the flight example, if you're flying from Toronto to Heathrow and you're just 1% off in terms of where you're tracking, you may not land in Heathrow. You might be way off course. And so the pilot's constantly adjusting, because of air turbulence and weather patterns and that kind of thing to make sure that they're tracking in the right direction. And so the second phase is constant adjustments are critical. So you need to update your plan regularly. I mean, the reason a lot of people will work with an advisor, it's not because the advisor has information that maybe you don't know. I have a lot of clients myself that are very knowledgeable, but they're living life and there's other things that they want to be attending to. And so they have an expectation that we will attend to those adjustments, those micro changes to make sure they're tracking in the right direction. So it's really, really important. You don't want to, set it and forget it. That's not how retirement planning works. It's a regular sort of discussion every year, updating the plan. And then attending to the small things. So everything does matter. It's really looking at your cash flow, your budgeting, the tax planning. I mean, all those different things add up to be big things. And then the final risk mitigation tool really is ensuring that you're making decisions as part of an overall integrated plan. So every time you do something in your retirement planning journey from a financial standpoint, it's going to have a ripple effect in other areas, either on your tax planning, your estate planning, your cash flow budgeting, and your portfolio. So you're always taking into account those dials. Don't be off course, always adjust. Make sure you're making constant incremental changes to stay on track. Make sure you're attending to the small things as you look at your checklist, and then make decisions in the context of an integrated plan. Well, let's look at the first risk. It's longevity risk. And so longevity risk is a critical factor because the longer you live, the more pressure you put on your financial resources. And most people have this sort of subtle subconscious concern. They don't want to have more life than income, obviously. So the chart that you see on your screen is just a good overall review of longevity. And so if I take a look at age, let's use age 80 in our example. And so if you're a female at age 65, then your chance of living to age 80 is about 82%. If you're a single male, your chance of living to age 80 is 77%. And in a couple situation, there's a 96% chance that one in the couple will live until age 80. If I go to age 90, there's a 47% that female will be living to age 90 at age 65, 38% for the male, and a blended probability of 67% in a couple situation. And what surprises people sometimes is at age 95, what's the chance you'll still be living at age 65, you retire at age 95. So female, 25% chance, male, 17% chance. And in a couple situation, the blended mortality chance is 37%. So almost a 40% chance that one of you, if you're in a couple situation at age 65, will still be alive. Now that has consequences in terms of a retirement planning. So what I'd like to do is just take a look at our SNAP software and we can kind of illustrate the impact of the different longevity numbers. Tom and Sally, they're retiring in their 60th year. In this analysis, we have them living until their age 85. That was kind of the default. They thought that was a fine number. And we talked about it, so I'll talk about another scenario that we ran for them. But at age 85, if they live to that date and they were okay with depleting all their financial resources, they'll still have real estate, then their sustainable spend was $89,185 per year, indexed at 3%. So $89,185 goes up to $186,734 to age 85. And if you look at the drawdown on their financial assets, I'll just go down to the net worth statement. You can see that all their financial assets in the light blue, green, and orange are fully utilized out to their age 85. Okay, so that's a sustainable spend in their situation. A sustainable spend is, again, $89,185. So as I was talking to Tom and Sally about this scenario, they initially thought 85 was a reasonable number. Then they watched my video on longevity. And they thought, wow, there's almost a 40% chance that one of us will still be around in our mid-90s. So we reran the numbers for them. We're using age 95 in this analysis, life expectancy. And the impact when we ran the numbers was that the sustainable spend was $79,000 per year after tax, which is about $10,000 per year less than the previous model, just backing up the life expectancy 5 years. So again, it may not change their planning a lot, but it was something they felt was helpful in terms of the context of some of the trade-off decisions they're going to make through the retirement years. And so you can do the same thing. We've got SNAP projections where it allows us to do different iterations, but you can also go to our website where we do have some calculators. So if you click the link back to our home page, you'll come to the home page, and at the bottom you'll see a menu bar, and you just click on Toolbox. Toolbox will then take you down to online calculators. Just click there, and you get to our online calculators. And then if you scroll down, you can see the various calculators, and you've got this calculator saying, will the money last, or how long will it last for? So I've got a basic calculator here. Let's just make a couple of changes. I'm just going to put 6% in here for both scenarios. You can scenario 1, scenario 2, Ones we're drawing $20,000, I'll put $15,000 into the scenario. So what you can do with this is you can put in your portfolio value that you're using, put in the interest returns, so we're using 6% for each, pull out the pre-tax income payments you're taking out for each, and then you can inflation adjust that income payment as well. So we're using 2% inflation. So the portfolio would last 17 years if you took out $20,000 a year. It would last 26 years if you took out $15,000 per year. So you can use this tool to kind of noodle what the potential longevity is of your portfolio based on different income scenarios. The next risk we'll talk about is inflation risk. We're calling it also inflation impacts. Again, we all know this. We've really lived it the last few years with cost of living going up pretty dramatically for basically all goods and services, it seems. But just a few examples here, then I'll show you a tool on our website that you can use to do your own modeling. Okay, so if inflation affects on $1,000, we're looking at various interest rates. I'll use 3% just for my example. So if we have a 10-year period and we've got $1,000 of money we can spend, well, at 3% inflation, by the time we get to that 10-year mark, we've gone from $1,000 of purchasing power to $739 of purchasing power. If we go out 20 years, that $1,000 will have purchasing power of $545, almost cut in half over that time period. So it's really important that you model the inflationary impacts. Again, when we run the SNAP projections, we're always modeling the impact of inflation. And there can be a lot of variability. So you might have your cash flows are going up at 3% per year, but maybe your pension's only being indexed by 1% through work because it's not contractually indexed. You might assume that your government benefits will be fully indexed. So you've got all these different moving parts in your plan, but bottom line, if you've got money you want to spend and you want to maintain your spending purchasing power, you need to take this into account in your planning. So we always really zero in on this with a laser focus. How do we protect purchasing power? We think about risks and we often default to market risk as one of the biggest risks that retirees face. It really isn't. It's purchasing power risk. It's an incremental risk that happens through things like poor fiscal policy by governments that erodes the value of our dollar and confidence. It's through taxes that can erode purchasing power, and it's also just overall economic forces that can do that as well. So we're at the mercy of that, and we need to build it into our planning. Let's take a look at the tool that's on our website. So again, when you go back to the listing of the calculators, there's a calculator over here that we refer to as inflation and retirement income. And you can see in this model, we've got an income amount. So you've got a little toggle here. You can go back and forth in terms of the income amount, but in here it's got $75,000 of income. We're projecting out 25 years. And the inflation rate, well, the long-term historical rate, this model sort of keeps track of that, is 2.23. Let's put this in at 3. So we'll use 3% inflation and show in future today's dollars. So if you look at that income potential, and we'll just take a look at it. So the current income is $75,000. And if we wanted to have the same spending power in 25 years, we need to be generating $157,000 by that date. And if we looked at the current dollars, just toggle this, so it's in today's dollars, you can see here that $75,000 today delivered to us in 25 years will have purchasing power of $35,820. And if you look at the long-term historical inflation, it's purchasing power of $43,212. So again, the ideal is to make these decisions and model these things in the context of your overall plan. But if you just want to take a look at what you need to cope with in your own planning and do some basic calculations, this model could be very helpful for you. We need to remember in our retirement planning that in our experience over 3 decades of working with families, 2 of the biggest risks in their retirement plan are, number one, not sticking to their after-tax income expenditure goals and deviating wildly from that. That can really derail the plan. So cash flow is critical. And the other is having the ability to weather price changes because of inflationary pressure, dealing with taxes, that kind of thing. Those are the biggest risks. The ones that people focus in on are market risks. Market risk can be dealt with. That's actually an easier risk to deal with than the incremental degradation of our purchasing power from inflation and not paying attention to our spending patterns and having a plan that is sustainable. That can only be done when you do your own planning or hire someone to help you with that process. So the next risk we'll talk about is market risk. This is the one that most people are concerned about. So I just finished saying that I think personally, working with hundreds of families, budgeting, tax planning, and inflation risks are in fact the biggest risks. And if you deviate from those categories, which you have a lot of control over, it can really wreck your retirement income plan. But market risk is a risk that we need to be focused on as well, and there is agency here. We can do things to protect us against market volatility. So if we look at the first phase, so we've got 3 phases of investing and dealing with market volatility. We have the accumulation phase, where we don't have to worry as much because you're not retired yet. But as you get closer and closer to retirement, you need to change your mentality a little bit. So this first phase is the easiest phase, believe it or not. It's just about discipline, putting aside the money, investing it. The more interventionist you get, often for many people, the more they hurt their portfolio. So get that money compounding. But as you get close to this transition period for retirement, you want to change your focus a little bit from purely accumulation of assets to strategies around deaccumulation. And that is definitely a different portfolio strategy than the one you're using to save for retirement. Bottom line is you want to start building in a little bit of a cash wedge or income wedge in your portfolio. This is money that's being taken out of the market, and it can be used just in case the market's not doing very well, and you want to make sure you've got safe harbor that you can draw upon without selling anything at an inopportune time. You want to begin that conversation with yourself or with your advisor, in my estimation, ideally at least 3 years before retirement. And you can begin incrementally building that part of your portfolio. Now, the risk zone, again, is a critical area. And this is now where hopefully you've built your cash wedge or income wedge, and you have other strategies in place, things like a line of credit that you could access if the markets aren't doing well. You've got your cash wedge in place, and you've built some buffer into your budgeting. So you've got your idealized budget as long as you're hitting all the numbers and the assumptions are happening the way you've developed your retirement income plan. But if those assumptions don't happen in reality, you have the ability to tighten your belt a little bit or use other alternative assets to produce income so you don't have to use assets that are not doing well at that time because of economic uncertainty, volatility in the markets. And then now we're retired, and for many people, as they pay out income, usually, now this is not always, but for most people when we do the modeling, it's a slow drawdown of assets. We're killing the goose that lays the golden egg over time. Now, you might be fortunate where you can just live off the income and the earnings, but my experience is most people are seeing this slow erosion of capital over time. That's not wrong. It just you don't want it to be too quick, right? You want a slow erosion as you get older and older. Now, 2 of the biggest risks to contend with, or planning areas to contend with, would be sequence of return risk and sustainable drawdown. So a lot of the work that we do, and you can do it on your own with spreadsheets or using some of the calculators on our website, is what is a sustainable drawdown so the money lasts long enough based on inflation assumptions and return assumptions. The second is sequence of return risk, and sequence of return is critical for those people who have money in the stock market principally. So although the market is up more than it's down, when it's down, you need to have strategies in place that protect you. And the worst time to have a down market, right, is right here when you retire. So in 2008, we had clients retire in 2007. I didn't have any clients unretire. And that's because we wanted to make sure that those strategies were in place to deal with that market uncertainty. So that black swan event, one of the worst markets ever in 2008, it was a terrible time for clients and advisors. But if the advisors or clients had set the proper strategies, they got through it. And so let's talk about the sequence of return risk just to red flag it, because it is an important area to take a look at in your plan. So the chart you see in front of you are 2 investors. Now, both investors have $1 million when they retire, and they both intend to draw out $45,000 per year from their portfolio, indexed at 3% per year to cope with the impact of inflation. Both portfolios generate consistently similar returns over time. But unfortunately, their sequence of returns is different. So the first investor benefits from 3 initial years of positive returns. So returns were 25% in year 1, 10% in year 2, and 5% in year 3, before experiencing a negative return in the 4th year of minus 15%. The second investor, unfortunately, experiences a more difficult investment environment in the initial year of retirement. So they experience a minus 15% return, followed by gains in the 3 subsequent years, 5%, 10%, and 25%. Now, for both investors, the same pattern of returns and income distribution continues throughout the remaining period of the retirement. So the bottom line is investor A has some initially good performance, and investor B had some initially bad performance. So the first investor benefits from the positive returns in the initial years, and their portfolio grows as a result, even as they generate income by liquidating assets. The strong start in the retirement plan allowed the investor nest egg to generate the desired amount of income for 40 years throughout the analysis. Unfortunately, the second investor, in a year when the markets were down, just a single year of negative returns at the outset of retirement meant their portfolio lost significant value. And because they were selling their assets into a down market, their portfolio couldn't recover like it would have during the pre-retirement period. This caused significant damage to their portfolio and their long-term strategy, and their money ran out by year 25. Now, clearly, if a client had gone through this particular circumstance, they would have changed their approach. So here we just keep spending through, those years at $45,000 a year indexed at 3%. But obviously there should be corrective action, and that individual would have to pull back likely some of their spending rate, or maybe they had cash or a line of credit they could have used to leave their portfolio alone, to let that portfolio reconstitute itself so they could recover from that really poor sequence of return at the beginning of the retirement. So we'll go back to Tom and Sally's cycle, and I'll just illustrate to you, when I'm using a snap forecast as an example, one of the things that we want to look at is stress testing on the plan. So we have a stress testing tab, and we can look at historical market returns and pick some very poor historical cycles. And we can also use randomized scenarios in the plan. So what randomized allows us to do is we set the asset mix. In this example, it's 25% cash, 75% equities in the portfolio. The long-term return is 5.96% nominal return over time. The net inflation return is 3.16%. And I could go and take a look at one of the worst case scenarios. So if we looked at the bottom, let's say 20% of scenarios in this plan, what it allows me to do is to randomize the scenarios. So this is a good example of what we're talking about. So I don't have too many clients where when you do a randomized scenario, we look at how much for inflation, cash, fixed income, and stocks, and we do the average return. So over the length of this analysis, this is actually a very poor period. You can see 4.09% nominal return from 2025 to 2061. But we also see the reason for the underperformance is the red is the equity markets went through a randomized scenario that was very, very poor. So the long-term performance in the portfolio is 4.09, but there was some real underperformance. So what we want to do is apply that underperformance to the model. So what we do is we go in and I'll just apply and run these investment returns in the model, and then we'll take a look at the snap forecast, and I can show you how that gets integrated into the model. So let's look at Tom. And in Tom's plan, we can see some variability here in the planning. So you can see that the return was minus 8.78%, minus 7.21, then up 14, up 13, minus 5, plus 18, 1.73, minus 16.7. So there's just this variability that happens year by year. And what you see is Tom's running into some shortfalls. If I look at the combined shortfall between Tom and Sally, you can see that there are shortfalls emerging in their 79th year. So this is a very bad historical period that we're modeling in this particular scenario, but it does create a conversation. And the conversation is, worst case, how do we need to change our spending patterns if that began to happen? Do we have defensive strategies in place, like a line of credit and income wedge at any given time? And if this happens, we need to act pretty quickly to readjust our situation to get through that period so we're not pulling out assets at a bad time if the market's not doing well. So this stress testing is a very helpful way of sort of hoping to improve peace of mind for clients, that they have the ability to get through these difficult times. But let's not put our head in the ground. Let's look at the model and then see how resilient your plan is. And then the last risk we'll talk about is demographic risk, which is a risk that we need to keep in mind as we do our planning. And that's just an aging population. So as the population ages, you can expect that healthcare costs will go up. Access to healthcare might get more difficult. There's going to be more pressure on pension systems. Hard to model what that looks like down the road, but I'll give you some ideas. Now, first of all, let's look at the trend line. So 65 plus demographic group was just about 8% of the population in 1971, 14.4% of the population in 2011, and by 2051 is expected to be about 25%. The biggest impact you see is that the demographic graph looks less like a Christmas tree, which it was in 1971. Lots of baby boomers paying into pensions and paying taxes for various support systems for the elderly. And then you see in 2051, it's a much smaller base, putting money into the pension systems and tax base to pay for care and healthcare services. The other thing that we see happening, and this has been my experience as an advisor, you'll see clients often in their mid-70s to late 70s sell their principal residence. That value then gets invested. It spins off investment income to help defray some of the costs of a retirement residence. And for the first time in decades, they've got a monthly rent cost. It could be $3,000, $4,000, $5,000, $6,000, $7,000 a year, depending on the facility. On top of that, they might have some additional assisted living costs, depending on their health in the facility. And then eventually, there could be long-term care costs that need to be built into the plan. So I haven't seen this a lot because it's in the future for a lot of the clients. It's hard to know what these trends are going to be, but I have had a few people begin wanting to model that scenario. Principal residence gets sold. It gets used to be put in their portfolio to spin off investment income and then defrays the cost of some of those accommodation costs down the road. And then they build in an extra budget for healthcare costs. So the important thing is just to think about how you'll defend yourself against this trend and then build that into your financial modeling as best you can. It's a bit of a moving target, but it's an important risk to begin thinking about when you look at your planning. If you'd like to get a copy of the slide deck for this presentation, just go to the show notes. There's a link there. Just click that link and you can download the show notes to the device. And as you review the notes, it's just a good reminder of some of the core risks we talked about today and whether you've dealt with them in your own planning. Longevity risk, market risk, the deaccumulation risk in your portfolio, and inflation risks. As well, there are links to the calculators referenced, and make sure that you subscribe so that when we put up more videos in this series, How to Retire, the playlist, you'll be alerted to those uploads that we'll be doing on a regular basis. And of course, we'll have resources in each video that you can download. It's a complimentary download. Now, some of you may like the information, you're finding it informative, but you're not sure that you want to go it alone. So if you go to our website, there's a discussion on how you can get a complimentary meeting to discuss your planning and find out more about our retirement income planning services. Anyway, wish you all the best in your retirement planning journey, and I hope you enjoy the ongoing video creation in this series, How to Retire. You take care. Bye-bye.